Good morning, everybody. My name is Josh. I am the head of option strategies here at Chaikin Analytics. Welcome to the third part in our three-part repeating series on options. This is the advanced part. We've broken the advanced part up into a couple of pieces. There's a lot of advanced strategies, so we're not going to cover every single one of them today. If we don't cover the advanced strategy that you would like to see covered, please email me and let me know. My email is first initial last name, so jmindlin@chaikinanalytics.com. We will do the next advanced in 3 weeks. A week from now, we'll start the series over at the basics options. So that'll be 1 week from today. But today, advanced strategies. Quickly, just a little housekeeping before we get started. Nothing I say constitutes advice in any way, shape, or form. I'm not an advisor. This is strictly educational as a way to show you how to use Chaikin Analytics with various option strategies. Me. Just briefly about me, I have been blessed to have been mentored and coached by some very impressive people who have spent a long time on Wall Street, people just like Mark, people that have run option floors like Mark, people who have been in the option pits. So what I really want to do is just be a conduit, a way to take what I've learned and just pass it along to everybody here with us today. So that's a little bit about my background. I've been doing this for the better part of a decade. I've coached hundreds, thousands of people. And I've coached them on things like this, which is what we're going to cover today: calendar spreads, ratio spreads, straddles, and strangles. So a calendar spread and ratio spreads are directional, and straddles and strangles are sort of non-directional. I mean, I guess they're directional, but you need what's considered to be sharp move or big move strategies. So we'll talk about those today. If anybody's doing any of these currently, please let me know. And also, again, email me with any other things you'd like to see covered in the future. Let's get into these, just right into them. We're going to start with calendar spreads, long calendar spreads. I don't really do short calendar spreads, but long calendar spreads, the basic construction is you have a long in the money option with a long duration, plus you have a short out of the money option with a shorter duration. The strategy is to take advantage of a bigger move over a bigger time frame while reducing your risk using shorter time frames. So the way we look to do this is, and this calendar spread could be any which way. You could buy, we could do long in the money this month. So we could buy the Augusts and then sell weeklies against it, sell this week against the month. We can go out and buy the quarterly and then sell the monthlies. We can go out and buy the leaps and sell the weeklies. There's any way you could do this, but the calendar spread really is buying a longer duration and then selling a shorter duration. I like to buy in the money, and I like to sell them out of the money. I know some people like to sell them at the money. There are different ways you can do this. Ideally, I like to have it set up where this is a low implied volatility strategy. You want to do this in low implied volatilities. And when you look at the width of the strikes, we want the premium to be less than the width of the strikes. And I'll explain that a little more detail in a minute. Let's look at the long calendar spread example. These are examples that I took off of the SPY. And these are not screenshots from today either, just so you know. But they are screenshots from our options play feature. It's a great feature. I use it all the time. Helps me quickly analyze these. Yes, it is. We are looking at diagonal calendar spreads. Correct. A non-diagonal calendar spread would be buying and selling the same strike at different durations. What I'm looking at here are buying and selling different strikes at different durations. So it technically is a diagonal calendar spread. Thank you for asking me to clarify that. So in the example you'll see here, I'm buying a leap, a a long-ended option for January of 2018. At the time, it was 227 days away. It's closer now. And then we look to turn around and sell the July 21st option. And you see that's the calendar spread. That's the difference between buying one farther out and then selling one shorter. Now, and this is also, as I said, a diagonal where we're doing different strikes. Some people like to do these calendar spreads where you use the same strike. So in that case, you'd be buying the 240 and selling the 240 just at different expirations. I like to do it where you buy in the money, one strike out duration, and then sell out of the money, shorter duration. As I said earlier, ideally you want to get the premium that you pay on the initial order. So if you look at this, the initial cost of this order is a little over $1,000, a $10.68 order. Now, what are the width of those strikes? The width of the two strikes are 10. The difference between the 240 and the 250 is 10. What I really like to do, and so this doesn't quite fit my ideal setup, what I like to do is have the premium be less than the width of those strikes. So what I really would like to do on a trade like this is find a short option or a setup. Maybe I need to go deeper in the money. The deeper in the money you go, the easier this becomes to do, at least the way that I like to trade them. The deeper in the money you go, the lower your extrinsic value. The more intrinsic value you have, the lower your break even, and it makes it easier to get the premium to be less than the width of the initial strikes. And that's just the initial strikes, because the expectation is that we're going to continue to sell these. The expectation is that after we collect our 40 cents for the 250, we're going to turn around and sell the August for hopefully about the same amount. In the end, the goal is to sell enough premium using the calendar spread, using the difference in dates, is to sell enough short duration premium to cover all of the extrinsic value from the initial order. Okay, if you need me to explain that again, please let me know. But what we're looking to do is on the one that we're buying, the 240 that we're buying in this case for 1108, we'd want to calculate what the extrinsic value is for that order, and then we're going to want to turn around and try and sell enough premium to get rid of it all over time. If I think that I can sell 40 cents every month and I've got myself 6 months, then I can expect to take about 240 away from the extrinsic value. So that's how I look to set up my calendar spreads. I do like calendar spreads. So that's a call example for a calendar spread. You'll notice that these tend to have higher probabilities of profit, higher odds of success. Partially that helps when you go in the money. The deeper in the money you go, the better your POP is, because again, you're reducing the break-even number, making it easier to achieve profitability. So the probability that you'll have profitability goes up. The other thing is you're selling against it, so that lowers your break-even number as well. Okay. In this example, I would have needed about $1 on the sell side in order to make this worthwhile. Again, the difference between the strikes is 10. The difference between the 240 and the 250 strike is 10 spread. So I want the premium that I'm paying in total to be less than the spread in total. So I want this number here to be less than the difference between these two on my initial entry point. There are some places that would really like you to get it even lower than that. Some places really want you to get it to be 75% of the initial entry. I think if you can do it at less than the spread, you put yourself in a good position right off the bat to be profitable. Right off the bat, you're in good shape because you have a premium that's less than the width of your initial spread. You have more room to run, so to speak, than the cost of it. So right off the bat, you're in a good spot with something like this, and then you can just turn around and keep selling them. That's the idea. Keep selling them. Let's look at kind of the setup that we want for a long calendar spread. I usually do not enter them at the same time. I usually try to enter them at slightly different times. I like to enter my long options when we are below the center line on the Chaikin bands, and when we're not overbought. So in this case, let me just mark this up for us a little bit just to give you a sense. What I want to do here is I want to enter my long calendar spread somewhere below the middle line. Here's the middle line in the band. So I want to enter somewhere below that middle line. My rule is just at or below the middle line. And I like to do it when we're close to or at oversold. So at this dip here, if I were looking at a calendar spread, that would be the time to go into the long. And then I would turn around and sell the short leg of it when we get to overbought and up toward the upper band. And then you just sell a short term duration. Usually it takes to go from peak to peak in the overbought oversold cycle, or to go from one full cycle to valley takes about 4 to 6 weeks, and we can expect that to go from oversold to overbought to take about 2 to 3 weeks. Right? So to make this move here should take about 2 to 3 weeks. We can then assume that the move back down will take 2 to 3 weeks. So if we're selling the short duration here and we sell for a month, my sweet spot usually is about 20 to 30 days. When I'm doing my short durations, then we can expect that we'll have pulled back and we can keep all of that premium. I will note, I like to buy my shorts back. So even when I do calendar spreads, and I have this debate with people, I know some people like to just let them expire worthless. I do not. I was taught not to. Most places now even offer you free commissions to close your credit trades. So if you are buying back, if you have sold a call for, let's say, 40 cents in that example, I personally would try to get 90% of it. So I would turn around and put an order, limit buy to close on my short call, limit buy to close, and I'd put an order of maybe 4 cents. That'd be 90%, or 5 cents. I had a mentor told me, don't be, I'll give you the cleaned up version. He said, don't be a weenie for a teeny, which basically just means don't try to pull a penny out of the market, right? Just take as long as it's close to what you're looking for, take what you can get. So, if I can buy it back for a nickel, great. I'm not going to quibble over whether 4 or 5 cents gives me 90%. And most of my brokers that I use, in fact, I think both of them now, are letting me buy back my shorts commission free. So yes. So I see that's the someone's typing in the actual term. I will not say that, but you are right. The cleaned up version is teeny for weenie for a teeny. Anyway, I got that from a guy that used to be a floor trader in the futures pits. Used to trade ES futures. I picked that up off of him. Anyway, so calendar spreads. Again, we want to try and buy when we are on one of these short-term pullbacks, when we're close to oversold. We want to have positive money flow, relative strength, power gauge. That's ideal. I really like when you have these pullbacks occur on strong money flow. That's great. However, you'll see there's this little blip of red here. If I saw a little blip of red when we were down here, that wouldn't have made me panic, honestly. I still would have been willing to jump into a picture like that. So that's long calendar spreads. So I don't always buy the underlying. That would be, if you buy the underlying, that's not a calendar spread necessarily. That's a covered call, which is a great strategy. Love covered calls. This is basically a replacement for a covered call strategy. We're replacing our 100 shares of stock with with one contract. In this case, yes, I don't worry about the short-term fluctuations. If the trade starts going against me, I don't really worry about it. Now, if I see what I call a character change, if the relative strength changes, if we fail to hold the long-term trend line when we hit overbought, if we have power gauge start to go yellow then red. Those are characteristics of a personality change, and I don't want to hold it through a whole personality change because I'm really trying to profit off of my long call. So I use the same rules for exiting this position on the long call side as I do for any one of my normal swing trades. If I see relative strength change, cut and run. If I see the power gauge turn red, I'm out. If money flow goes red in the short term, that's not so bad. As long as we're above a rising trend line, I'm pretty much comfortable with it. All right. All right. If I hope that answers the question. The other thing you can do is if the stock does, let's say, go neutral and you don't really want to bail yet, you're not sure, you can always be a little more aggressive with the short calls to try and lower the cost basis. So that's an idea. It is a little more risky because it goes up. If the stock does continue to go higher than you thought and goes above your strike, then your short leg is going to have losses, and that's not what we want. So, all right. All right. So this is a put example. It's basically the same thing, just the other side of it. You buy a long put far out in duration. Again, I use the same durations. I just flipped around the strikes. In this case, the width of the strikes, this is a good example here. The width of the strikes is 13. The cost is 1180, which means that the cost is less than the width of the strikes. In the call example, it wasn't. It was more than it, right? In the call example, we were paying about 1060 for something that only had a width of 10. In this case, we're looking at a width of 13, and we're paying less than that. We're paying 11 and change, almost 12. So this is what I was talking about in terms of what I'm looking for to get into. It's one of the metrics that I'm looking for. And on the put side, you're basically doing the same thing as you're doing on the call side. You're taking one long duration, and then you're looking to lower the cost basis by selling on the short duration. So in this case, you want to enter, if you're going to be doing put calendar spread on a bearish stock, which I like, then what I would do is I look to enter my bearish trade. So we have poor relative strength. We have poor power gauge down here. That tells me it's bearish. A little bit of green here. Again, I don't worry about so much. I would much prefer that it look like this when we pop. It doesn't get green, but if it does get green, that is okay. I don't mind. What I'm looking to do is I'm looking to enter my put when we are overbought and, again, above this middle line here. So anywhere above this middle line would be a good entry point for me as long as we are also overbought or close to overbought. That would be where I want to buy my put, and then I'd want to turn around and sell when we are oversold and close to the lower band. Short duration, again, is what I like to do. I like to only go out 20, 30 days typically. What that's going to do is it's going to, one, out of the money in short duration, it's all going to experience a lot of theta. The entire premium is open to theta decay because it's all extrinsic value, and short duration is when theta is the worst. So what I'd expect is for us to go from oversold to overbought, as I mentioned earlier, about 2 to 3 weeks. If I sell 3 to 4 weeks, then I should find myself somewhere like you see here. If I sell out of the money when we're oversold and near the lower band, let's say I sell the 60s. This goes up, this goes up. A couple of weeks later, cover the 60s, out I go. Right? And then we just turn around, rinse, repeat. A question on the money flow, going green. Couple questions. It could be the result of a short squeeze. Honestly, don't really know. Personally, I don't generally care what the result of it is. I look at money flow, just real quick, a quick analysis of money flow. I look at money flow and it should be doing one of two things. It should be either following price or it is diverging from price. If money flow is following price, that's what I consider to be the normal state. That is, price shoots up, money flow goes up, right? Price goes down, money flow goes down. That's what I expect to be the normal state for money flow. Now, you'll notice in this case, price went up. I mentioned this earlier. This is divergence. This is price goes up, money flow flat at best. In this case, price went up, and at the same time, money flow couldn't get positive. Those are negative divergences and usually lead to short-term drops. When I see this sort of move like this, and I see a little bit of green in the context of a stock that is now up about 8% in a few weeks, that doesn't shock me. Money flow is measuring institutional activity. Institutions may have been squeezed out of it. Maybe they're just using they're lowering their cost basis on their positions. They're selling the high end of the range and buying the low end. I don't know. I guess the short end of it is I don't particularly care as long as money flow is doing what I expect it to do. Then it's not a big deal. All right, so I'd be perfectly okay given this picture here, especially in the context of all of the other indicators. The relative strength and the power gauge at the bottom here, those are my biggest directional indicators, and those are clearly red. The long-term trend line is falling, and price is below it. I mean, those are pretty clear indications that the next 1 to 3 months is going to be lower, regardless of a little blip on money flow. Money flow can be a little volatile. All right. So let's talk about ratio spreads. Ratio spreads are ways to take advantage of, well, at least short ratio spreads, also known as front spreads, are neutral to small directional bias. They do technically have unlimited risk in one direction. If you do them for credit, which is what I usually encourage people to do. You want to do these typically for a credit, and I'll show you the example. You tend to eliminate risk in one direction. You do have unlimited risk for a big move in the other direction, but this is designed to take advantage of short moves in one direction while eliminating them in another direction altogether. All right, I'm showing you a 1x2 spread example. That's where you have one option that you buy and then you short two against it. That's where we get the ratio from, right? We're buying one and then selling two. Ratio spreads could be buy one, sell three. Could be buy three, sell seven. Buy two, sell three. Any numbers. It could be any ratio, as referred to as a ratio spread. I've seen all kinds of crazy ones done. Oftentimes, they're done like that because people are trying to achieve delta neutrality, and I'll explain what that means in a minute. So front ratio spread, as I said, we want to do these for a credit. Ideally, you want to do them for a credit. And what we do is we buy one, and then we turn around and we sell two farther out. All right. So we're going to buy one closer to current price, and then we're going to sell two of them farther away. What we're looking to achieve is the two that we sell gives us more in premium back to us than the one that we buy. And you can see here, in this case, when we buy one and sell two, we came up with an $80 credit. What does that mean? Well, look at the graph here. You'll see, doesn't matter how low we go, we profit. That's that 81. Now, the other direction, for a little while, we make money. And then we start losing precipitously. And that's because we're short two calls against only one long. So for a little bit, we have potential profit and then tank. This is a great strategy for a couple of reasons. First, it eliminates your directional risk. Second, you don't need big moves for this to be profitable. Okay. In fact, you specifically don't want big moves for this to be profitable. I would be aggressive in managing positions like this because you don't want to wake up one morning and have this thing gap to this price point here. You know, yesterday you were sitting right here and thinking, well, maybe it'll come back a little bit and I can make a little more, and being greedy, and then it gaps up a whole bunch, and that's not good. So you want to manage these, sell them for 81. If you can, make half of your total max. In this case, you could have profited up to 280. Maybe if you can make 140 off of this, or maybe 2/3. But I would be pretty aggressive in managing your profits on this because, one, you have high probabilities of success. So, oftentimes you're going to be profitable. Don't wait for it to be unprofitable. Take them when you can get them. And because this is an unlimited risk strategy, you don't want to get caught on the low end of this. Managing risk is one of the biggest things that professionals do. They don't take big losses. Big losses hurt immensely. We don't want big, we want small losses when we can. So you want to manage that. You could put in a limit order to exit this strategy for a profit, and then just let it sit. And if you get close, at the end of the day, you're close. If you're watching it, just take it, because if you're sitting at $200 profit one day, I would not wait for the next day for that last $80. I would pat myself on the back and say, wow, that was a good trade. And then I would go and do it again. All right. This is also good for fairly range-bound stocks. This is true. Things that are consolidating, that is true. Generally, pretty good strategy. You can do this in either direction, by the way. So this is the short call example. Remember, short calls are bearish, which means we profit down, right? And you'll see we profit more to the left than the right here. Here's where you want to do this sort of strategy. Again, it is a mildly bullish, mostly bearish strategy. You profit more from a move down. Even though you profit greater money from a move up, there's more profitability prices below than above, right? Any move lower is still going to keep profits. Any move up will not. Some will give you a little more, some won't. What I like to try and do is catch this when you have, again, a bullish scenario like this, but I try to catch this sort of style after it's leaving oversold and as it's moving up. Right? That's what I'm trying to catch this. As we go from oversold up, catch it up, short moves higher, take the profits and run. So as it's leaving oversold, I think personally is the best practice on this. It means that you usually have the dip already behind you and you don't have to worry about too much more down days. I would not want to be doing it here in the cycle. Although, the suggestion that it goes lower means you'll just keep your premium. But we're not looking to play this for the down move. We're looking really to play it for a slight up move. we're protected on the downside. That's the beauty of the strategy. But we're really looking for a small move higher. So ideally, we want to catch it just as it's leaving oversold and heading up, maybe just as it bounces off or hits this this middle line here in nice bullish stocks. That should give you nice repeatable results. I personally try to stick to a 30 to 45 day window on these. So you max your profit when at the short strikes. Just that's typically where you're at a max on this. Oops. So here's a put example. In the put example, you'll see the ones that you're selling are the 242s, and that is going to get you profitable right there. That's where you're going to max out at 242. So if you hit your short strikes, that's ideally to get out. Again, I would tend to encourage people to get out when you are above the credit that you've received, but not at the peak. I mean, if you're watching it intraday, and then you can put a limit order in and see if you can get there. If you're not able to watch it intraday, then I'd put a more aggressive limit order in, and assume that it will trigger your aggressive exit here before price smashes through that and you have losses. Make sense for everybody? On the put example, again, it is mildly bearish because we do maximize if we go down a little bit, but we are protected on any move higher. Okay. Any move higher. And again, you'll see we're doing this for credit. We're going to take in on this trade, we're going to take in $193 right off the bat. So one way of doing it. For a put example, again, it's just the inverse of the call one. In this case, we're looking again mildly lower move, so we'd want to do it as we're leaving overbought. Just like the calls, we want to do it as we're leaving oversold. We would look to do it as we're leaving overbought, and we can expect price to have a short little drop. We're not looking for big moves. Okay, you'll notice on my examples of these, if we go back, that these strikes are not far apart. I'm not setting these really wide strikes. I probably could have gone a little bit lower, took in a little bit less of a premium here, and then had a bigger potential maximum reward. I'd prefer to take the money up front a little bit than to have this peak be a little bit higher up in terms of profitability. All right, we're looking for small moves over a short amount of time. Okay, and again, we're trying to catch these little drops. All these little drops after the little peaks, that's what we're trying to do. So where price is now on this image would be, I think, a little bit aggressive on it, but not such a bad spot either. Because what we can expect is move down 2 to 3 weeks, move down. This is a downtrend, so we might even go lower. Also 2 to 3 weeks. Remember, small moves, you're not looking for big moves. You want big moves, other strategies. This is for small moves with eliminating directional risk in one direction. I think it's a lot of professionals use this strategy. I'll say that. All right. Next, back ratio spreads. Back ratio spreads is just the opposite. In this case, we're going to short one and go long two, whereas before we were going long one and short two. For the short ones, but for just quick, I always go when I get a credit, when I'm receiving a credit for my strategy, I always stick under 45 days and I try to stay in the 20 to 30 day range. Debits, when I'm getting a debit, like we're talking about these back ratio spreads, which are long ratio spreads, I like to go a little bit farther out in time. I like to go more than 60 days. With a back ratio spread, These are going to be done for a debit. You're going to short one in the money or at the money option, and then you're going to have two long out of the money options. We're coming into earnings season. This is a strategy that takes advantage of big directional moves by reducing our risk. It's usually a very low cost way of playing a directional move. Instead of buying very out of the money, you can buy a little bit closer, use the short one to lower the break even number. So it gets you a little bit better. I know a lot of people like to take flyers by buying out of the money options around earnings. This is a way to do that with less risk and lower break even as well. So your short one and long two, again, this is just a 1x2. We could do this any which way. We could be short 3 and then long 5, short 1 and long 5. Again, we want to try and do it for delta neutral. What do I mean by delta neutral? I didn't explain this on the last one, but I'll explain it here. What we want is for the delta on the one we sell to offset the two we buy. For instance, if the delta on the one we sell is, let's say, 0.5, right? We have a 0.5 delta here. Then in this case, we're going to have two of these. We would want this delta to be a negative 0.25. Why? I'm going to take the 0.5 and I'm going to subtract 2 multiplied by my delta. I did these backwards actually. The short call would have the negative delta and the long calls would have the positive delta. So in this case, it would be a negative 0.5 and a positive 25. Let's get that. All right. So this one would be, if you're doing it at the money, then you're going to have about a 50 delta. And then in these two, you would look for, and I'm just making these numbers up just for easy example purposes. But in this case, you're short one at a negative 50 delta. You want these two, whatever the delta is, to add up to this. So it offsets. One offsets the other. One side of the leg offsets the other side of the leg on the delta. All right. If you have low delta, it means that your premiums are not going to move much on a move in the stock, and that's what we want, because a sharp move can turn into poor profits on the front ratio spreads, the credit ones. And here we do have minimized risk. We do want a big move. We're going to rely on gamma to help us with that, which is gamma tells us how far delta moves for every $1. In this case, we want small risk, low costs. Low costs, we're looking for big moves. These have lower probabilities of profit. But as you'll see here, it costs you $50. Your whole risk, your maximum risk is $250, and that is if we end up closing right here at the short legs, or sorry, at the short strike. All right, if we close right there, that's our max loss. Not likely to happen. Why I think these are good earnings plays is because if you do get big moves, you've now risked $50 basically. I mean, your maximum risk is $250, but it really only cost you $50 out of your account for all kinds of unlimited rewards. Pretty leveraged, because you're going to have two long for every short one here, however that works out. All right, 1 to 3. You can do it in any which way. You typically want to do these for a debit, a small debit. All right, this would have been a great way to play Netflix earnings yesterday. Yes, correct. Think of a 10% move higher in Netflix when you own two calls and you offset that risk by selling one. It would have, Netflix is a high flyer too, so those premiums are a little bit bigger. I mean, I did this on on SPY, which is a similar price stock, I guess it's in the hundreds, so to speak. And you can see that we were able to do this one for a fairly low amount. For earnings, you don't need to go that far out. You know, for earnings, you want to play product announcements, things like that. You don't need to go, if you're playing specific events, you don't need to go far out in time. I only have 45 days on here. If you're doing this for a longer play, then you might want to go farther out in time. You might want to go out 60 days for something like this. Okay. So this is a call example where we're short one near or at the money, and then we buy two out of the money. Fixed risk, one direction, very small, and good unlimited reward. The other side of this, again, the best thing you can do on these is, this is for bigger moves, so you want to try and catch these as best you can. The lower in the bands I can catch this, the better. Or if I'm just playing a particular event, I'm not as concerned about where it is in the cycle if I'm playing a specific event. But again, ideally, you want to be, if you're looking to make moves up, you want to be closer to oversold. So you don't want to be overbought. Right now, this is not the position you'd want this sort of trade to be in. You don't want it to be overbought. You would prefer to wait until this pulls back a bit. It looks like price is leading the indicator a little bit here. And that you'd want to try and take it closer to oversold and below this middle line. That's going to give you room to run, and you need that to make good profits on this. Even though it is a low risk strategy, it is also a low probability strategy because you're buying out of the money options. Here's the same example, same strategy, just on the other side, just on the put example. So this is a bearish strategy for a big move lower. If you thought that people were going to have earnings misses and drop and tank, this is a strategy that you can use. Again, you have a pretty low probability of profit, but you also have a fairly low cost and a low risk. Right? Look at the difference between the risk and reward on this one. On the call side, you have unlimited reward because theoretically we could go as high as we could possibly go. Here, you can only go to 0 on the stock. So your max reward is the difference between your break even and 0. Again, if you're playing a specific event, you don't need a lot of time, which can make this even cheaper. I could have probably looked at the weeklies on this, although I do still like to go about, on the debits, more than 45 days. But if you're playing a very specific event like earnings, you can get away with less. By the way, if you're playing earnings, I encourage people to take strategies for earnings, debit strategies for earnings, a week or two in advance of their earnings. And that has to do with implied volatility run up before earnings announcements. So if you can get into your debit strategies ahead of earnings by a week or two, preferably 2, then you tend to get better prices, less implied volatility, lower expected moves. That expected move gets bigger as you move toward the hype of earnings. So long put example. Again, in this one, we want it to go down. We would like it to be in the position that this is right now. You want it to be oversold. You want it to be above this middle line. As close as I can get to this upper band, the better. But you'll notice if you always wait for it to hit the upper band, you're going to miss a lot of good trades. So my rule, again, is above the middle line, at or above this middle line, which gives me a good number of opportunities. Again, for these, I try to catch them a little bit higher. I try to be a little bit more, even though it's a low risk trade, I try to be a little more conservative on my price entry because you do need a bigger move in order to be profitable. So I want to try and get as high on the expected range as I can because it gives me more room for the direction that I'm looking for. The closer I get to this upper band, the greater the distance is to the lower band. And you'll notice we hit the lower band quite a bit in classic bears, just like we hit the upper band quite a bit in classic bulls. So that would be a put ratio spread. Lastly, today we're going to talk about straddles and strangles. These are also big directional moves, like our front ratio spreads, like our long ratio spreads. These are big directional moves. You can profit from an increase in volatility. The straddle is where you are buying a long call and a long put, same strike, same expiration. All right. You're basically sitting and looking for a move on either side of a single strike. So it's like you're straddling that strike both directions. That's how it gets its name. And this is for a big direction in either way. The ratio spreads that we talked about for big moves are pick a side, pick a direction. In theory, you could do one of each and play it like that. Or you could look at something like a straddle or a strangle. The only difference between a straddle and a strangle is not the same strike. A strangle is different strikes, same expiration. But both of them are looking for the same basic thing, a big move. In this case, you need a move big enough to cover both sides. One of these is going to be a loss. That's the nature of it, right? If you have a big move up, the put loses. If you have a big move down, the call loses. What you're looking for is a big enough move that doesn't matter which way it goes, it's going to pay for both the call and the put. High flying volatile stocks are great for this sort of strategy. Again, you want to do this farther away from earnings, though. The farther away from earnings you get, the lower, typically, the lower the implied volatility. And in this case, you can profit simply from an increase in volatility. At the money options are the most sensitive to changes in volatility. They have the highest vega. And so if you get a rise in implied volatility, that can really help you. I would look to put this strategy on when you have low implied volatility relative to your historic volatility. I like to look at current implied volatility and compare it to the range of 30-day historic volatility. If you have any questions on that specifically, email me. Okay. But what I like to do is I like to catch these sort of trades when the implied volatility is at the lower end of the historic volatility, 30-day historic volatility range. I typically look back about 6 months and check out the range of the 30-day HV. And then I see where is current implied volatility in that. I want it to be low. It doesn't need to be all the way at the bottom of the range, but I want it to be maybe in the bottom third of the range. And the reason is vega. I expect that if we are at the lower end of the volatility range, that volatility will increase. It will be what is called mean reverting, meaning heading back to its average. All right, you get too far above the average, you pull back to the average. You get too far below it, you pull up to the average. And in this case, if I can catch implied volatility while it's below the average, significantly below the average, I can expect that it will return to the average, and that as it does that, I will profit from the increase in volatility. We do lose on time decay on this, though. There are trade-offs. So here's a long straddle example. In this case, I looked at buying both a call and a put at the 243 strike on the SPY. You can see it would have cost me $606. I would have needed a move big enough to cover both sides for this to work, right? So it would have needed to either move up a certain amount to get it to break even, or down a certain amount. You'll notice that my break even points are on either side of it right here. Your max loss is if it doesn't go anywhere. So this is to cover, something like Netflix yesterday. This probably would have worked out. Generally speaking, though, we're looking for big moves. If you can catch these in low implied volatility environments, that's pretty good. In this case, we would have needed to move $6 in either direction. So either up to 249 or down to 237, which you can see listed here, right? $6 move to cover either way. In SPY, that is a sizable move. A $6 move is it's like 20% move. So that's kind of a big move. I would not expect that on here. I know this says it has a probability of profit of 41%, which is pretty good. If you can get these above 30, 35, if you can get above 35%, I'd say that's a solid spot to get them. The higher the better, of course, but remember your debit strategies tend to have under 50% odds, tend to have under 50% odds. Not always, but you know, that's what they tend to have. And the credit ones tend to have higher ones. The difference is the credit ones have fixed profits. The debit ones have usually much higher profits. Okay. So that's a long straddle. For these, you could use a neutral stock. It can be used as a great earnings volatility play. Something like this, I would want to catch. I would want to catch this somewhere near the middle, right? Because you need to make a big move either direction. And if you catch it up to the high end of the range, it's probably not going to make a big move higher. You might have a big move lower, but that's not what you do a straddle for. A straddle is when you're trying to anticipate a big move either way. So in this case, I would look to try and catch it in the middle of the range, right along the middle line. You might even want to look to try and catch it right in the middle of the overbought, oversold oscillator as well. And finally, you could use a neutral stock for this. I happen to stick with the example I had because it was a nice little example. But you could use a neutrally rated stock for this as well. The more volatile the stock, typically the better. But again, if you're paying up with high volatility, it makes it tougher. The lower the volatility, the easier the strategy is to profit on, because it does require a big move. Now, you could do a short straddle. A short straddle would have probably a pretty high margin requirement. The long straddles are only going to, whatever it costs, it costs. There is a debit strategy, but the short straddles will have pretty high margin requirements for something like that. In fact, short straddles, you might even you probably need you need the best option levels that they have. They're different option levels. Like level 1 is you can do cash secured puts and covered calls, and then level 2 is they let you do singles, and then level 3 they let you do spread. This is like whatever the highest level is to do something like this. In fact, most of the strategies today require higher levels of option permissions with your broker. This one is going to require the highest, and it is has unlimited risk in both directions. Now, high implied volatility is where you want to do the short straddles. You can get paid quite a bit, right? Like 20% on the S&P is a nice paycheck. I did a short straddle a couple months ago. I got paid 10% of the for a 10% move. So I was covered from a 10% move either way, which is pretty cool. Now, this is naked both directions. Again, unlimited risk on either side. So you really got to be careful with what you're doing. You'll see your break evens. In this case, this is the inverse. Your break evens are, we just flip this around. Instead of buying it, we're selling it. We make 600 at a max. We maximize our profit on this if the stock goes nowhere. So a long straddle is a big direction move. A short straddle is a neutral range bound, right? We want it to stay in between these break even marks. In theory, if you don't like doing it like this, you could add long legs to either side and do what's called an iron straddle. Similar to an iron condor, which we'll talk about in 3 weeks. If you want to listen to my iron condor conversation, go back 3 weeks and look at the presentation I did 3 weeks ago. We covered them there. But in theory, what you could do is you could add in a long leg on either side of the option, and that way margin becomes less, because then you don't have unlimited risk. You fix your risk at the long legs. That's one way to handle this. It reduces the amount you make and reduces your probability of profit, but it does cap your risk. So food for thought on that. You want to do these, again, similar to the other ones, even more so. You even want this to be even more neutral. You could do the long straddle on a neutral stock. You really would want to do these on neutral stocks. Neutral stocks with flippity-floppity, what I call flippy-floppy, or neutral relative strength, where it's kind of bouncing above and below. The flatter the trend line, the better. Again, you want to catch this pretty much at the exact same spot that you sold it. So if you enter the trade here, you want to exit the trade same spot, right? So the flatter, the long-term trend line, you probably want to catch it somewhere in between. I would do it on a 3 to 5 week time frame for short straddles. All right. What I was talking about earlier in terms of an iron straddle is similar to an iron condor, which is, in this case, we are selling at the money. In this case, at the money would be right around here, right? We'd be short 2 at the money. So we're going to just say we're short 2 right there. And then in theory, you could buy the wings and turn it into a iron straddle, where you're short 2 at the money, or sorry, you're short 1 call and 1 put, and then you buy a call and buy a put as a way to cap the margin requirements. That's one way of doing it. Be known as an iron. Again, that would be known as an iron straddle. Similar to this is the strangles. Strangles are just like straddles, except you do them out of the money instead of at the money. So a straddle, we did a long call at the money and a long put at the money. These are out of the money. Same basic concepts, though. You would want to go, you're looking for a big move. You're looking to profit from increased volatility. You have losses from time decay. All right. It wouldn't be a ratio, because you'd be buying 1 call and 1 put against your short call and put on the iron straddle. Strangles would have the same sort of thing. An iron strangle is an iron condor. Just right. You add long ends to the straddle, or this is a long straddle. But when we get to the short straddle, if you add ends to the short straddle, that's an iron condor. But the basic construction of this is just out of the money. We're looking for big moves in either direction. This is how I set this up. The other one I set up both at 243 or 244. This one I went a couple strikes higher, a couple strikes lower. Our cost is lower because we're not at the money. We're going out of the money. Out of the money costs less. So in this case, our cost is less. Our probability is also a little less, but that's because we need a bigger move than even the straddle. The straddle costs more, but doesn't require us to move as far. In this case, we need an even bigger move for us to achieve profitability. All right. Sometimes you can find it where it doesn't take much more of a move. That's ideal, but usually takes a little bit more. You also have a bigger area here for max loss before you start seeing it turn toward profitability. Long straddles and strangles, the same basic concepts. You kind of want to get in around the middle line. You need a lot of room up or down for this move. It's a great strategy for earnings. We're heading into earnings season. It's a great strategy for earnings. There you go. On the short strangle, just like the short straddle, Sorry, I get tongue-tied over straddles and strangles. It's a 2-letter difference, so 3-letter difference. 2-letter difference. Just change those. So in this case, we're going to sell them both. It does still have unlimited risk in both directions, but you need to go a little bit farther. You also have a higher probability of success on this. This is, if you're going to do these near earnings as a way to, you want to do these in high implied volatility environments. Any short strategy you want to do in high implied volatility environments. Any debit strategy you want to tend to do in low implied volatility environments. That's going to be the best way for you to keep profits, make profits easier to achieve. The debit sides, I almost always go in the money, and the credit sides, I almost always like to go out of the money. So I prefer short strangles to short straddles. You just don't always get as much. The other, what I was mentioning earlier is if you add a long leg to these, that is, if on the short call you add a long call to it, and then on the short put you add a long put to it, all of a sudden you have an iron condor. So a short strangle with 2 long legs attached to either end, one long on one end and one long on the other, that becomes an iron condor. And we'll talk about iron condors 3 weeks from now. We'll go specifically into iron condors. It's my favorite neutral strategy, honestly. So short strangles, just like short straddles, we want to try and catch it in the middle with a flat long-term trend line, neutral relative strength, try to catch it in the middle of the overbought, oversold. Remember, we don't want this thing to go anywhere. Range-bound stocks, this is great for. Okay? And we want to try and do it in high implied volatility environments. That's going to give us the most premium that we can get. Any other questions? You guys have been fantastic. Ladies and gentlemen, you've all been wonderful. I appreciate the questions. The next one will be options basic. It will not be June 14th. It will be July 26th. It'll be July 26th, and we'll be back to the basics. It will be same time though, so it will be July 26th at 11:30 to 12:30 Eastern time. Will be the next one. You can call us, please. There's a number there. Call us anytime. You can also email. If you email into support@chaikinanalytics.com and you just put options in the heading, I will answer it personally. I'll personally answer your questions. I'm happy to do that. People send me options questions all the time. So I get back to you as quickly as I can. As long as I'm not doing another presentation, I'll be happy to answer the question as soon as I see it. So this concludes our 3-part series. For those of you that have been with us from the beginning, that is fantastic. I hope that you've learned a lot from this. If you think that this series is valuable and has been helpful to you, then I encourage you to do 2 things. First, let us know. So give us feedback. We like feedback. The second thing that I would ask you to do is to tell your friends. Let them know. Say, hey, I use this program. It's called Chaikin Analytics. And I'm learning options with it. And I'm pairing these options with this powerful program. And I'm doing well. Tell your friends that. And ask them to give us a call. All right? And we have a referral program that we're rolling out, so you can be early on into the referral program. We'd love your referrals. If this has been valuable to you, please let us know and let your friends know. With that, that's all I've got. Hopefully I will see you all in my voicemails, in my inbox, in my future sessions. I appreciate it. Again, if you have any other questions after we stop. Oh, this is being recorded and will be available in a few hours. If you have any other questions, please email them into us. I appreciate everybody's time with me today, and I look forward to speaking with you in the future. Thank you.